Ladies and gentlemen, very many companies and also public entities will reduce their CO2 emissions, their carbon footprint, either because they want to or because they have to, due to government regulations. Today, we are going to discuss what this means for the portfolios of investors, for their stocks, for their bonds. Welcome to our panel. My name is Philippe Béguelin. I'm from Wirtschaft here in Zurich. I'd like to give a short introduction of the panelists. On the right-hand side, from your point of view, is Fabio Pellizzari. He's from ZKB Asset Management by Zürcher Kantonalbank. And there he is head ESG strategy and business development. Thomas Leys is with abrdn. And there he's investment director of fixed income research. Fong Yi-chan is with Vanguard, and she's head of ESG strategy for Europe. And Jonathan Davis from PineBridge Investments, he's client portfolio manager, emerging market fixed income. And we are going to talk about risks and opportunities of CO2 reduction in the portfolio. To start, I would like to give each member of the panel a little time to explain to you their point of view and what they're doing. Maybe we start with Fabio.
Yes, so my name is Fabio. As mentioned, I work for Zürcher Kantonalbank as in the ESG strategy. That's the Thema lead. We've been integrating ESG into our assets for over 25 years. Last year or 2 years ago, we decided to commit to the Paris climate agreement, meaning we decarbonize the carbon footprint of all of our active assets every year for the next 30 years. So we've also committed to the net zero asset management initiative last year. So we manage roughly 220 billion in assets, half of which is passive. We manage fixed income, equities, multi-assets, and real estate direct. We obviously also have the famous gold ETFs, which is now less in scope, obviously, for carbon reduction, but this is kind of what the house has to offer.
My name's Thomas Leys. I work for abrdn in the European credit team. I've been heavily involved in shaping some of the climate strategies we've got, and I'm a lead manager on the Climate Transition Bond Fund we have, which has a very strong focus on real-world impact when it comes to climate change and investing in corporate bonds.
Hi everyone, I'm Fong Yi-chan. Within my role, I help to integrate ESG considerations into our products that have explicit environmental social objectives, and as well as thinking about how do we integrate ESG across non-ESG products. I think the thing I wanted to highlight for the group for Vanguard is that Vanguard, we have different asset classes that we manage, but we're managing them on behalf of 30 million clients. And so our approach to ESG is really grounded in our fiduciary duty. And so when we think about integrating ESG, we have a 3-pillar approach where we engage, we allocate, and we avoid. So in our index funds, these funds will be inevitably exposed to material ESG risks, and we see stewardship as being the primary lever for safeguarding our assets from ESG risks. On our allocate pillar, we also have an active book of business. For fixed income, most of it we manage internally, and our active fixed income managers will be integrating ESG from a financial materiality perspective. We also work with a number of external managers, and our perspective is that external managers have their own philosophy and own processes for integrating ESG, but we do expect them to be systematically integrating this information into their research processes and also into their stock selection. And lastly, we have our avoid pillar, where within our passive range, we also offer a number of products that help clients avoid certain sectors or activities that are in line with their values.
Jonathan Davis, client portfolio manager on the EM fixed income team at PineBridge Investments. PineBridge, we've formally integrated ESG scores in our EM fixed income processes for over 6 years now. And I'd say in my personal kind of role as CPM, as events like these have been far less frequent over the last 2 years, that role has kind of shifted as to taking on more of an ESG strategist role within the team, and I think that's probably my next business card will be ESG strategist first and CPM second, but happy to be here.
Thank you very much. Now, one of the big questions with regard to the portfolio is what to do with the biggest polluters. We could simply exclude the worst CO2 emitters from our portfolio. So, Thomas, what do you think? Is such a divestment a sensible strategy?
Yeah, so I think, as with a lot of ESG questions, the answer is often not just yes or no. It's a bit more complicated than that. So, when we look at what we need to do to mitigate the causes of climate change, we need to bring down emissions in the real world. So, a simple looking at the top emitters in your portfolio and just selling them might not necessarily achieve that. Obviously, it will bring down the portfolio's carbon footprint, but it won't necessarily lead to any real-world emissions reductions. Now, obviously, that's not to say that we should just hold on to them. We need to do the research, understand what trajectory companies are on, and try and pick the ones that are on that aggressive decarbonisation path. If we look at the European utility space, back in sort of 2013, 2014, if you take a company like SSE, a UK utility that at the time had fossil fuel, or quite significant fossil fuel assets, it was one of the highest emitters in terms of power emissions intensity, power generation emissions intensity. If you were just selling companies that had high emissions, you would have sold that company because it was higher than a lot of its European peers. In the following years, it rapidly invested in offshore wind, onshore wind, retired a lot of its coal assets, moved away from gas as well, and basically, quickly decarbonized and became one of the leading European utilities in terms of emissions intensity. So, if we think we should be providing capital to companies that are making changes like that, most of the transition needs to happen in these dirty sectors and in emerging markets as well. So rather than selling them, we need to pick the right ones. But that's not to say that we're not going to set milestones for companies and expect them to hit certain targets. So eventually the engagement will be necessary. Divestment will be necessary. But I think if you do so, make it clear to the company why you're divesting. Tell them, we're divesting because you're not hitting these targets to have maximum impact, and also be public about it. If we as abrdn, as an investor, say that we are selling this company because we no longer think it meets certain targets, we think that can have quite a strong impact.
Yeah. If I may just add, so Vanguard's perspective actually is very similar to yours. And I think one thing that I want to actually maybe pivot the discussion a little bit is what are investors' goals for wanting to integrate climate? And if we think about some of the experiences we've had around working with our clients, client preferences and goals typically fall within 4 buckets. One around wanting to align how they invest with their values, around effecting meaningful change, around financial benefit, and as well as adhering to regulatory requirements. If we focus on the first 2, values and affecting meaningful change, if there's a desire to effect meaningful change to the low carbon transition, is it more effective to own and engage and have a seat at the table to encourage certain behaviors and actions to facilitate low carbon transition, or is it more helpful to divest? So Vanguard's position that it's more helpful probably to own and engage with companies on climate risk and to facilitate that low carbon transition.
If you, for example, if you have a client that is worried about their own reputational risk as well, that might be a reason, and then it might be good to divest, no?
So there's options for them. There are options where you might want to exclude, but I think it's really important to drill down to what is your motivation for integrating climate? Mm-hmm. And so again, is it values? Is it affecting meaningful change? Is it financial benefit because they see climate as a material investment risk? Or is it about adhering to regulatory requirements? And I think reputation might be related to that.
Mm-hmm. Yeah, and just on that point about motivation, if you're purely looking for a portfolio carbon emissions intensity number that's X percentage below the benchmark, then sure, you obviously have to hit that somehow by constructing your portfolio in that way. But if you take a thoughtful approach about what are we actually trying to achieve here? Are we actually trying to achieve real world emissions reduction? Which we're talking about the Net Zero Asset Managers Association and a lot of these trade bodies. That is the real priority. How do we actually bring down emissions? So as you say, it depends on the motivation, and yeah, I think taking a sort of thoughtful, measured approach about who to pick and who to back, and then divesting the ones that aren't on that path, I think is important.
And Thomas, you'd made the comment about investing in emerging markets, engaging in emerging markets. And I think for us, to get to your point about what do you value, there needs to be some sort of acknowledgement of a need for a just transition away from fossil fuels, right? It can't just be sitting in an office such as this in this part of the world, sort of using the climate objectives to sort of beat down economies that are just earlier in their industrialization. So we need to think about how we can help partner with issuers who are preparing economies that are dependent at this moment on fossil fuel revenue for what they will be faced with in a net zero reality that hopefully is met by the 2050 goal. How are those communities going to be better positioned to participate in that economy when the fossil fuel revenue no longer exists? So that's something that we typically tend to engage upon, not just with respect to sort of the fossil fuel assets, but also other investments within our universe.
So if you focus on maybe on a path for them, how to reduce CO2 emissions in the futures, isn't it difficult to keep track, to control, to know whether they're really committed or they're just,
Well, therein lies the need for engagement and consistent engagement and being consistent in what you'd like to see your issuers accomplish to maintain a status of an investor company, right? So for us, we follow a very sort of disciplined approach with respect to how we're going to engage issuers and how we're going to sort of impact for the change that we're hoping to see for those issuers. And as Fong said, divestment is certainly an option at the end of a series of escalations that we might want to have. It's not our first path of action. We prefer to engage and help promote change. And certainly if that doesn't happen in a consistent fashion and you're consistently let down, then divestment, not just for our own portfolios, but maybe for the broader firm as a whole, and again, making that public is definitely on the table.
I agree with what has been said. So there's kind of a second piece to the puzzles. On the one hand, you need to do engagement, obviously, but on the other hand, there's also the capital allocation. I think capital allocation is the most powerful way of basically moving issues into the right direction. And I think it's not time to divest now. So there's a 30-year transition to net zero, to 250. So of course, one piece of the puzzle is engagement, is regulation, etc. But the other piece is definitely capital allocation. And we've set maximum thresholds. So we have kind of a reduction, CO2 reduction path for each active portfolio, which starts in 290 and it starts to reduce by 4% every year. So the absolute emissions and not the intensity for 1.5 degree products needs to reduce 7.5%. So basically we lock in a max value at any point T that the portfolio is allowed to have. So that doesn't mean that one single company maybe is not yet on the pathway, but it means that if a company is above the max value, you have to offset it with another investment which is below. And I think this is clearly what we communicate then in the engagement efforts, saying, okay, if your carbon footprint doesn't move in line with this 4 or 7.5% reduction, then it becomes eventually unattractive for us to hold you in the portfolio. So we need to start to divest, and divesting not completely, but go underweight. And finally, the divestment, if you see that the management doesn't care about climate targets, if you see the board doesn't have any climate targets, what we want to see typically is that it really is painful, so there needs to be monetary incentives, it needs to be on a board level. If this is just one sustainability guy that deals a little bit with climate, and we see over time they're not reducing, this is probably the moment you try to talk to the companies and you tell them what the consequences will be. But divesting just now, not giving them the option to really transform, is not what we think makes a lot of sense, because then these equities or bonds maybe end up in other hands who care less than our organization, and then we've had examples like this a lot of the times, that someone divests from coal and then it's privatized and then some private equity investors basically monetize the asset on a way dirtier means than you would do as a listed equity investor.
How do companies react, or maybe you have an example, if you tell them that you are going to underweight because they don't meet their goals?
Well, how they react. I hope they take us serious. It depends a bit on your assets. We are not having globally the assets that Vanguard would have, obviously. But in Switzerland, we are number 3. So basically, we are the 6th biggest investor, I think, in Zurich, financials, so Zurich Insurance Company, 10th biggest investor globally in Nestle. So in Switzerland, we have very good access to the management teams. And this is a process you take with them, like with Holcim, for example. It's been a long engagement process with us, not only with us, also UBS and other entities in Switzerland engaged with these companies, which finally leads to a commitment at Holcim that they really take this serious, And in Switzerland, obviously, Holcim is the big carbon emission. It's like 70% of all the listed companies. So they listen, especially if more and more companies do the same. And then we have Climate Action 100+, etc. We had the small hedge fund in the US, that basically forced 3 board members of Exxon out because they didn't care about climate risks. And, this is really powerful. And I think the companies themselves, if you see how much are becoming part, how many companies want to become part of the Science-Based Target Initiative. We have like 1,300 companies that have kind of said they want to become part of this initiative, while already 1,300 companies have committed to targets. I think there's a big movement there, and the companies do acknowledge that there's a certain risk for their businesses.
If I may jump in here and just take a slightly different angle. I think in addition to things you could do in a portfolio, when engaging with companies, there's also this element of accountability and escalation. Right? So when Vanguard, when we engage with companies, we want to understand how does the company understand what climate risk impact their business, how do they have adequate board oversight, and as well as how are they disclosing this information to the market in a way that's aligned with globally accepted standards like Task Force for Climate Change Related Financial Disclosures, TCFD. Now, when it comes to a situation where the company isn't able to demonstrate to us that they're adequately managing climate risk, then there's escalation, right? And you mentioned the example of Exxon. There is that accountability where actually maybe there needs to be differences in how the board has capabilities around managing climate risk. So it doesn't mean that you always have to pull the investment lever. There are things you can do from a management, a board perspective that can actually maybe a more positive thing for the company to help them with that transition.
Now, as a bond investor, there's not a whole lot we typically like about a rising rate environment, but I do think one of the things that comes out of that is the need for better access to financing at a decent cost of capital. And so for issuers within our market, where there's typically a pretty wider spread than necessarily where Thomas is investing in the European credit market, in a rising rate environment, if we're able to sit with issuers and tell them you will borrow at cheaper financing rates if you do X, Y, or Z with respect to improving your sustainability risks or climate risks, then that's a real meaningful change that is going to happen for those treasurers to put into their consideration of how they're going to act. And it's a very powerful tool. I think typically people maybe underestimate the impact that fixed income investors can have engaging with issuers, and it might be true in some more developed market contexts where the issuance is so large and the investor base is so large, but for us within emerging markets, there is a definite real ability for us to impact for change engaging with our corporate bond issuers.
I'll just add that we found it quite effective engaging fixed income alongside equities, because to have both sides of the capital structure there, at the table speaking to management, I think can be quite powerful as well. And actually, Holcim's another name that we've been speaking to as well to continue to put the pressure on them as a large emitter. But I think having sort of as many voices behind it, and I think it's not as simple as we say we're going to divest and then they immediately go and change things. It's just more like a sort of death by 1,000 cuts, just constant people bothering companies, and eventually, they start to listen. And the huge take up in science-based targets and just increase in disclosure is, although we're still a long way from where we need to be, we have seen quite a lot of momentum in corporate disclosure, corporate target setting, just corporates taking the subject a lot more seriously in the past few years.
I think the binding target is really important to us as well, because otherwise everyone engages and in the end you don't reach the target. So if you don't say it will have consequences, this is a maximum value that we're allowed to have in the portfolio, that's the risk that we fail. And there's we see governments failing, there's 190 countries that commit to the Paris Agreement, that have ratified the Paris Agreement. On the other hand, you have in China, Philippines, and India, you have 1,400 coal power plants that are built, going to add another 2.2 carbon, annual growth in carbon, just by these coal-fired plants. So somehow that doesn't match, right? And everyone talks about it, commits to it, but then, there's no action, also withdrawing from combustion engine, first they said 235 in China, now they moved that to 260. And this risk also happens, with investment stewardship. Everyone talks to them and then the companies miss, and then what? So I think if it needs to have a hard commitment, a hard goal, where you start to divest and you start to reshuffle your capital. Otherwise it's not powerful enough. And also for clients, the clients in the end, we have a fiduciary duty, so we want to manage the climate risk, and there's significant risk investing in a company today, which, let's talk about the utility sector, it still has 40% coal, and they sit on huge coal reserves, and these are priced in the books, and you don't want to be the investor that ends up with those stranded assets. And it is our duty as an asset manager to protect our clients from future losses, And we've seen this disruption happening quite fast. Tesla is another phenomenal example. Now, how is it possible that the whole German car manufacturing industry kind of sleeps for 30 years, and now in the end we have a situation where a US tech company, Tesla, is equally large as the 10 biggest car manufacturer worldwide? So, this is a disaster, right? And basically, you want to protect your clients from these sorts of trends, and these trends will happen much, these disruptive shifts, they will happen much faster in the near future.
I feel like we talked a lot about engagement, and I love how you referenced the country commitments. If one of the challenges around incorporating climate is, we use climate as a very broad term, right? Climate risk. What does it actually mean to investment? I think it's important to also break it down into physical versus transition risk, and how these two pieces play out from a changing consumer preferences, regulatory change, how chronic, how acute weather changes like extreme weather events or chronic changes like rising temperature might influence the creditworthiness of a country or a muni. But I think one of the things that we struggle with as an industry in integrating climate risk in an effective way is actually the lack of clarity on government action. So it's clear that many countries have made commitments to net zero, but then some of them have ratified, but there's no clear roadmap on when exactly certain policy action will happen. So we expect that there will be some rise in carbon price. We don't know if there will be an implementation of carbon border tax. We don't know when electric grids will be upgraded in order to really access renewable sources and also account for fluctuations in renewable sources. So all those things are still very ambiguous for the investment industry. And many of us have been thinking about scenario analysis because the regulators are asking us to do this. But that still doesn't give us the confidence in understanding what the future will look like. So I think that's one thing that I did want to highlight to the group, that we talk about climate in a very broad umbrella way, but there's all these component parts where we're still missing some of the granularity in that detail to really integrate this adequately from an investment risk and opportunity point of view.
Jonathan, if you talk to governments in emerging markets mainly, do they give you a step-by-step roadmap, or they just commit, in 2050 everything will be fine? It's difficult to manage, isn't it?
It certainly is difficult to engage with government and sovereign bond issuers more than you can. More difficult to engage with them than you certainly can with corporate management teams. I think the challenge that you have is as you say, the targets can be ambiguous and the targets can move, and it's difficult depending on the size and the vulnerability to external financial risks. How do you use your influence to try and drive change? And I think one of the areas, not to turn everything back to kind of engaging more on the private sector and kind of influence for change there, but in some of the countries within our universe, the change and sort of the shift and the transition really is led more at the private sector level than at the public sector level. So where you might find a harder time engaging with, say, like the Mexican government on issues of ESG risk, you can maybe back into that impact for the broader country by engaging more with the corporates and having that become more of their kind of overall policy within that nation.
Okay.
I just wanted to pick up on that point about credibility, because we see that as a huge sort of problem and something that we have to spend a lot of time trying to figure out when we're doing our company research on picking names for the climate fund and just doing climate research more broadly. Because I think it's very easy for a CEO to set a net zero by 2050 target. And unfortunately, a lot of lists are created and data sort of picking up companies with net zero by 2050 target tick. But when you go in and look, does the company actually have any interim targets? Is the technology even available to decarbonize this industry in the near term? Do they have like CapEx plans around that? What's their track record? Why are they even doing this? Is this part of like a strategic shift for the company? Does it actually make sense financially? So, we spend a lot of time distinguishing between ambition and credibility. And, I think it was the IEA statistic last year that 40% of companies with net zero targets had not set out any plans as to how to achieve them yet. So, we'd much rather see an ambitious 2030 target with clear plans, or even 2025 targets, rather than that. And we get some seriously ambitious claims made by companies like airlines saying they'll be net zero by 2025 by using offsets or something. We'll look at that and obviously chuckle because the technology is not available to fly, commercially viable electric planes that are fully net zero. So it really, you do have to investigate and really try and establish a sense of credibility when you're looking at these plans, because there's a lot of ambition, but the credibility is often lacking. Yeah.
You mentioned that the airlines, just kind of funny story. I was on vacation with my family the week before last, and we were flying back on Delta and on their little cocktail napkin it said net zero emitter since 2020. And I took a picture of it and I wanted to bring it here to kind of as my prop, but then my son spilled the soda on himself and I had to clean it up. But yeah, certainly there's some interesting claims.
Yeah, and even when you think about like the direct emissions, if you think about the materials that go into building planes, not even just the fuel associated with that flight and the kind of offsets that they're claiming to use, the whole supply chain will have a huge carbon footprint still that's nowhere near net zero. So yeah, that would make me laugh as well.
You were talking about stocks and bonds, both of it. If we try to compare them a bit with stocks, I think one of the most important measures is to engage, as you explained. Because if you sell the stock, someone else will buy it and the company maybe doesn't care at all. With bonds, it might be different. You give some money to the issuer, maybe for a certain project. You have a green bond. And there still you're not sure, is it really a new green project or is it something that they would have done anyway? So maybe, Fong, if you could, to start up a little bit, compare how do climate risks look different for stocks and bonds? How do you deal with this?
So I'll offer one perspective, but I definitely need to defer to my colleagues on the other side to provide fixed income perspective. I mean, from equity, so I would highlight two pieces here. One is, I feel like the industry, when we talk about climate risk, we often talk about it from the corporate perspective. And obviously there's intersection with corporate fixed income. So that's one piece. So what we haven't really solved for yet is how do you assess climate risk and also net zero ambitions for countries and also have an industry perspective on what is good and what is bad. There are various methodologies out there, but there isn't I would say a consolidated point of view around that. So that's one piece that's different because just the underlying categories of assets require different methodologies. And the data for sovereigns, munis and other non-corporate non-corporate assets are just not as well developed as corporates. The other piece I think is worth highlighting is time horizon. So in equity, we think long term, right? When we engage with companies, we think about climate in the long term. And as a result of that, you can be a bit more comfortable with some of those ambiguity in what might happen in the future because you're thinking about the long term. For fixed income, I think one of the challenges here is the differences in time horizons, 1 year, 3 year, 5 years, and so forth. And in those shorter time horizons, there's still a lack of clarity around when policy will kick in. And also, certain policies might influence how whether or not we can limit temperature rise below 2 degrees Celsius according to the Paris goals. So I think the two pieces I will highlight is the underlying asset classes, but as well as the time horizon differences.
And so within fixed income, and maybe this also goes back to your earlier question and to the point you made about how you engage with sovereign issuers or municipal issuers. I think of the example of the Bolsonaro administration in Brazil. Early on, destruction of the rainforest and deforestation was almost encouraged by that administration. And there was a pretty swift reaction among investors. A consortium of investors had kind of went to that administration and said, look, we will no longer be able to fund you if you continue with these activities. And certainly there was also public opinion within Brazil that was against him as well in that space. But we saw a pretty dramatic shift in policy from the Brazilian government with respect to how they protect the rainforest under the current administration. So you can impact sovereign issuers, but it does take a bit more coordination among all of us to do so.
Thomas, maybe how do you assess, for example, green bonds? Is there some greenwashing sometime, or?
Yeah, it's harder to find instances with no greenwashing. No, but I think like green bonds have been a very useful instrument, and the best green bonds do achieve very virtuous, worthwhile causes. There is just, as you say, a real risk of greenwashing in that space. I mean, I've covered the real estate sector for a long time, and I think in that space you can quite easily issue a green bond by just having some green buildings in your portfolio. So, say you've got a portfolio of 10 billion and half of them are got some sort of green label, and you can set the standard wherever you want. You can issue 5 billion of green bonds attached to that, even though you bought them 10 years ago. So you can use it to refinance debt that's allocated to those assets. So no additionality. The money just goes there and kind of finances those assets, but nothing's actually changing. I've actually seen companies issue green bonds that don't even have an ESG report, don't even report emissions. So there is a lot of sort of quite low standard of green bonds, but then you do get others where, the projects are, clearly earmarked, that the money's been put towards, energy efficiency improvements, build out of renewable power, and, you get really detailed reporting on, the actual impact that that's having. I've seen some companies talk about, per dollar, how many sort of emissions have been avoided or offset. I mean, you've got to take some of these numbers with a pinch of salt, of course, but they do play a role, but I think you still have to do your homework basically and make sure you know what you're buying. I think some of the initiatives that the EU is trying to do around creating a green bond standard might be quite helpful, sort of requiring this concept of additionality. Is the money actually going to lead to something different happening, like the point you mentioned? So I think it does have strong potential, but there are obviously still dangers around using it.
Fabio, you overlook stocks and bonds. So
the climate target is equally for stocks and bonds. So for corporate bonds, it's the same as you invest in equity. Well, it's a different structure in the end, but you engage with a company, so you also engage on the debt side. So you can just use the carbon of the corporate itself, and then for the green bond you have to figure out how much it saves in terms of carbon. And then on the sovereign side, I'm partly shocked, how no one really talks about the sovereign. No matter where you look in the industry, everyone just talks about the corporates, but in the end we're also giving money to sovereign, and we also have a climate target for the sovereign part, which is, of course, way more challenging because you have less selection, In corporates, you have utilities that have 100% coal, which is fossilized, and then you have the modern ones, which have a lot of, some gas for transition, a lot of renewables. So you have a factor 100 sometimes in the carbon emission or intensity. But in sovereign, it's really difficult if you have a benchmark with only 30 countries in it, or 20 countries, so there's not much selection. So you have to make some very pronounced allocations, which may not always be in the best interest of your client short term. So there's it's more challenging. Because, in the corporate side, you have a company like Korea Power Assets with 60,000 tons of carbon per million, and then you have companies that have 10, 12 or something tons of carbon. So it's very easy to find that selection and offset. And in emerging debt, for example, very difficult. And then you have to think about where the benchmarks are going, Globally, we still grow our carbon, unfortunately, by 1.2%. So you emit each year 50 gigatons of carbon into the environment. We have a remaining budget of 465 gigatons, so that budget will be used in 7-8 years, so we're going to miss the 1.5 degree target. And so this is the challenging part, If you need to go down 7.5%, annually, but your benchmark goes with 1.75% in the other direction. The gap of what you have to do with your capital allocation is getting more and more. So you need higher tracking error budgets, and you don't have this engagement component. You cannot engage with China, Indonesia, etc. on the coal plan. So that is the challenging part there. But nevertheless, we find it important that these asset classes are not forgotten, as well as real estate direct, for example. We equally have a reduction path for.
Okay. Is there a question from the audience to the panelists? Over there.
Hi, sorry. I just wanted to follow up a little bit on what you were saying in terms of how difficult it is dealing with national governments. And I was wondering, with all we've seen with how the Russian government's been kind of frozen out of all finance with Ukraine, does that then pave a pathway for how you might be able to treat governments if you think they're maybe not as extreme, but how maybe you can set up consequences for governments if you think they're not following through on their climate pledges as an investor, or is that far too extreme?
It probably is more of a tangible issue when you're talking maybe smaller nations that are more dependent on external financing, right? Fabio mentioned China, Indonesia. It's pretty difficult to imagine, an investor-based community putting the clamps down in a way that has a meaningful impact on their ability to kind of continue operating. But some of the smaller nations within our market, sub-Saharan African nations, some of the smaller nations in Latin America and Asia, you probably can have a bit more of that lever. But I think it's probably more case specific, and Russia certainly is a far outlier in how they've been sort of isolated.
You were saying it's maybe good if we keep bothering the companies and asking all the same questions. So what do you think, is it better to bother them continuously by many different banks, or will it have more impact if the banks on that topic at least, because there's no competition on the empowerment or in the influencing of the corporates, put themselves together and then come together with what you said, really clear questions with where you want clear answers, and you really monitor them together, or is it better to have all these different points? What do you think?
So I'm happy to maybe address this first, and then others can chip in. So there are a number of collaborative initiatives, like Fabio mentioned Climate Action 100+, and others where they are bringing investors together. So I think that is an important tool that we can use. But I think equally important are, I know we talk about disclosures a lot, and actually disclosures are really important because it is a demonstration of how companies are thinking about climate risk and how they're addressing it. And also, when you have information disclosed into public markets, then you're able to price this better into how you will value the company. And so I think in addition to collaborative engagements, and that's why Vanguard, we are so adamant about understanding, how are you disclosing this information so that we know how you're addressing climate risk and engaging with boards on this issue. So I think those are two really important levers for us to use.
Yeah, I think on the disclosure piece, the move by the SEC in the US recently to start making climate disclosures mandatory was a huge milestone. I think it might still get some pushback, but I think, as you said, if groups of investors are getting that information, and a lot of us are members of these net zero asset manager initiatives, the pressure is kind of coming from all angles. If companies are increasingly forced to disclose these risks, and managers are increasingly looking to decarbonize, and we've got actions like Climate Action 100, I think we could probably do more, but I think it is coming from all angles at a coordinated level as well.
In terms of how you pitch being better on CO2 to investors in terms of the return expectations and the implication of that, is there a cut-off for where they would tolerate the pain, I guess, that we've all been talking about sort of here? Is there, how do you work out what the premium is for a good CO2 company versus a bad one in terms of incorporating that into your mix for return expectations?
Yeah, I can answer it quickly with respect to the Climate Transition Bond Fund. So, here, we don't want to buy an expensive credit just because it's a good climate story. We're looking, because it's quite a broad opportunity set, and we can go emerging markets, developed markets, high yield, investment grade. We can focus on the names that we still think are attractively priced from a returns perspective. So we probably won't be investing in the kind of the shiny names that everyone associates with climate change that kind of all the ESG investors are in. We'll be kind of doing, trying to basically find the ones that haven't been discovered yet, maybe, or looking in regions where climate change is less of a focus, so it's not really as priced in. So I think you still can find attractive names that are on that pathway, and that's part of comes back to the original question around divesting the dirty sectors. So I think within those sectors, there's not much kind of greenium attached, or that green premium attached to some of the dirtier names. But if you find the ones that are changing quickly, I think you can still get attractive returns. This kind of comes back to the tracking error point that you were talking about. Having to have some tolerance around it.
I feel like one thing we didn't really touch upon is solutions. We talked a lot about divesting and transition, but I think there's also a need for allocating capital to companies that are producing products and services that address climate change adaptation and mitigation. And on that point, I think it's worth highlighting to the group that the EU taxonomy helps to better define what are those activities. And what you probably find is that there are companies that aren't usually associated with being great doers or whatever of climate, but actually within their diverse business, they might actually be producing some activities or services that are in that value chain of the end products for climate solutions. So it's worth also thinking about that piece. And when we talk about Paris-aligned benchmarks, yes, there is a CO2 or greenhouse gas emissions reduction pathway, but equally an important criteria within that benchmark requirement is also exposure to green solutions. So let's not forget the opportunity side as well for the climate transition.
Right, so we come to my last question, if you could answer briefly even, so it's a big question. What actually does the war in Ukraine mean for the whole climate change or climate transition? On the one hand, energy security has become very important again, with all the dirty energy as well. On the other hand, if fossil fuels are very expensive, that might be good for renewable energy. So briefly, if you would like to start, what will it mean?
Yeah, you already mentioned, higher fossil fuel prices obviously gives an incentive for, other solutions that we just heard. So it's also an opportunity. So these, offshore wind, onshore wind, solar technology is becoming more competitive. There should be further incentive. The security piece is difficult, but I think we've seen an overreaction, short term, because basically Europe mostly needs the gas, that comes through pipelines. But, if they're going to install enough facilities, to liquefy the gas, and they're already planning those, you're going to have other options to import your gas, as a liquid into Europe, and then you become less dependent, let's say, from Russia in the near term. Of course, that has a higher price tag because the transportation and the process, of liquefying the gas is intense. It costs a bit, but not in the, not in this price increase that we've seen for now. So midterm or long term, yes, probably gas as an important transition fuel, fossil fuel, is going to be slightly more expensive, but this will also, feed hopefully the renewable energy part and energy efficiency part.
Thomas?
Yeah, I'd just say, for me, it just highlights more than ever the need to have, clean, renewable, reliable, domestic source of energy, which obviously renewables can provide. But yeah, obviously the build-out phase is just longer than is feasible. So, in the near term, there's obviously concerns around that. But I think it's also interesting, and it kind of highlights, we're talking about supply, do we need to start reinvesting in coal, gas, and domestic oil? But actually, a lot can be done on the demand side. The EU's been very vocal about sort of increasing insulation in properties, moving to heat pumps where you can use electricity to heat homes instead of gas. So I think, this really should spur a lot of the demand side action, because, we can reduce our reliance on fossil fuels a lot from the demand side rather than just also thinking about purely the supply side.
Yeah, energy efficiency,
Yeah.
I think is a big piece here. And I think the other perspective I would add is around nuclear power. So I think from a ESG investment perspective, and I'm using that as a very big umbrella term. In the past, a lot of the SRI funds have thought about nuclear power as being a controversial area because of the potential risk around nuclear waste and when things go wrong. I think that concept of whether or not nuclear power is a key part of the transition is being looked at much more carefully now. So many of you in the room probably will be aware, within EU taxonomy, there's been a recommendation to include nuclear power within the green taxonomy. It's still a very political discussion within Europe, but I think like from a ESG investment perspective, this area is going to be looked at more closely, particularly because of the energy security challenges. Nuclear power could be a very viable way for us to wean off fossil fuel dependency.
Yeah, I think for me it highlights just how sort of complex even an issue that seemingly should be maybe less complex, climate change, and I think all of us agree that there's risks of climate risks are a very real existential threat for everyone in this room and everyone on this earth. But I think it highlights the complexity. Fabio mentioned the LNG terminals. Who in here would have thought of investing in an LNG terminal in Western Europe as a good ESG investment, not that 2 years ago or less so? And I think now when you're faced with there's going to be a need for electricity either via coal or via LNG at some stage in Western Europe with the pipelines being shut to Russia, then LNG becomes much less of an ESG risk in the near term in that transition to renewables. And I think the thing you then have to think about longer term in the shift to an economy where more of the world's energy is produced by renewables is how do we source the materials involved with the renewable energy production, where China has a sort of a dominance in solar panel production and polysilicon and rare earth production. So then you're again back to that security question again, where if we're all in a renewable planet that's dependent on one country, we're a bit more vulnerable to the whims of that government. So it's a very kind of ongoing cycle of risk and what you do to meet those risks and invest for solutions to manage those risks.
Great. Thank you very much to the panel. Thanks to the audience for listening. Thank you. Have a good day.